Good evening, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully you guys had a very decent day in the markets today. Now, in today's action, the S&P and the QQQs and most of the market pulling back again. The third straight day of losses for the SPY and the QQQs, and that hasn't happened in over a month. Now, in terms of the news that hit the markets today, there was actually not that much that would have led to such a very large decline. The market started off the day with the SPY down almost 1% and the Qs down almost 1.25% before we were able to retrace some of those losses intraday. Now, the only news that came out this morning was, of course, a stellar GDP revision for Q2. 3.8% was the annualized rate of expansion for the economy, and that was versus the 3.3% rate that was anticipated. So, why were the markets down on such bullish news? Well, once again, guys, it has to do with the balance of risks to the Federal Reserve in terms of where do the risks lie? Is it really towards inflation? Is it towards the labor market? Now, the Fed has commented several times that it believes that the risks now are to the employment side of the dual mandate. However, when you get some hot GDP reports like this, and when you also get a preliminary PCE inflation report that comes in at 2.1% quarter over quarter, as you can see right here, and the core coming in at 2.6, well, it raises the question again. Does the Fed really need to be cutting interest rates in this environment? Initial jobless claims was a lot lower than expected. So even though Powell has said that the labor market is soft, and we know that because the non-farm payrolls revisions just a few weeks ago showed that there were just less jobs being created in this economy, despite the fact that we are not currently seeing still massive layoffs. So as per his words, it's a no hiring, no firing economy right now. The GDP numbers are still very strong and inflation is slightly upticking, even though the Fed was very clear in saying that, well, these increases in inflation as a result of tariffs may just be a one-off. So the reason the market is reacting like this, even though last week we got the summary of economic projections, which actually gave us the path of interest rate cuts, is because the market right now is just undecided of whether or not the Fed actually needs to be cutting rates. And whenever you have some decent data like today in terms of the GDP, you will see yields spike to the upside, especially the 10 and 20-year yields. And this is just the bond market and or the bond vigilantes trying to call the Federal Reserve's bluff, essentially saying, listen, normally, you guys only cut interest rates to manage a lot of risks or to counter some damage that's already been done. Now, Jerome Powell said that last week's interest rate cut was indeed a risk management cut, but the market doesn't seem to believe that the data is bad enough to warrant that. So as a result, in the most recent few days, you've seen yields really tick back up here on the 10 and 20-year yields too. And every time it seems that we get one of these reports this week, we just go down as equity prices try to unprice rate cuts. And then when we get other news reports, they try to reprice in the rate cuts. So as you can see, the narrative is still front and center on rate cuts. However, in my opinion, guys, all of that right now is just quite simply noise. All of this is just normal price action in my opinion. The path of rate cuts is very clearly defined. Sure, there was some discrepancies between the 2026 amount of rate cuts that the Fed was anticipating versus what the market was anticipating, and that's fine. But the few things that are very clear in my mind right now is number one, the labor market is still very tight, and although not in a healthy jobs creation environment, we're not seeing massive layoffs and unemployment rate is still at a very low historical average of 4.3%. So the jobs market, although not the strongest, is definitely not falling off a cliff. Number two, GDP. Well, it goes without saying, guys, GDP right now is very strong. You might not hear that when you talk to consumers about their discretionary purchases, but people still have their jobs, people still have their homes, and they are spending money, maybe not on the same things that they were in 2021 and 2022, such as goods and electronics and things of that nature, and or things that require financing because rates are still high. But they are still spending money, especially on travel. So the consumer, although a bit tight still, is still very decent, in a very decent position. And number three, in terms of inflation, guys, well, even though the CPI and the PCE report are coming in slightly harder than expected, well, the argument can be made that those aren't truly representative of the actual inflation rates in the economy because it reflects a very limited basket of goods. And I keep bringing up this website right here, Trueflation, which measures over 15 million products on a daily basis. So arguably, it's a lot more reflective in terms of the economy, or in terms of the inflation rates in the economy right now across various sources of goods and services. And you can see right here, it's 2.01%. This is 15 million products on a daily basis with 30 million various different price points. So that being said, although tariffs may be impacting a certain limited amount of products, it's definitely not everything, and it's definitely not structural at this current stage. So in terms of checking on all three, the labor market, decent. Inflation, still decent. The consumer, still decent. And we saw that from the bank's earnings last quarter. We saw that from the credit cards. We saw that from big box retailers as well. Some companies are struggling here and there, but still, for the most part, everything is still looking fairly good. And the bull market thesis is indeed still alive. So everything that happens here in between, in my opinion, is just noise and a little bit of very casual price action. We were running very hot on the SPY, daily overbought conditions, on the Qs, daily overbought conditions, and the market was just begging for any or which excuse to kind of have a little bit of a sell down and possibly go into a little bit of consolidation. And in my opinion, that's exactly what's happening right now. So that's it for your introduction, guys. Hopefully you enjoyed that. I figured I should do a quick recap because this is the last video of the week for me. I'll only be seeing you guys on Sunday for the top 5 options update, but hopefully you guys are able to end the week strong, despite the fact that the markets have been largely pulling back for the entire portion of this week, for the most part, right? That being said, in today's video, we got a lot of things to cover. 2 company earnings we'll be starting off with. Those are going to be Micron and Costco. So we'll have a look at those 2 companies in a few short moments. Thereafter, we will do our full technical analysis rundown of our major market indexes, the SPY, the Qs, and everything under the sun, and see where the rotation is, where we can possibly find some nice opportunities. Thereafter, we will get into our big tech list as well and do the same thing. A lot of big tech names have been consolidating, so it raises the question, are there now some very juicy opportunities across our favorite big tech names on this list? Quick little hint, the answer is yes, so we'll be going through those in the part 3 of the video. And then to wrap off the video, we'll be taking a very brief look at the biggest gainers and losers of the day. I won't be able to go as deep as I usually do into this list because we do have some earnings to cover, and I want to keep the video obviously as short as possible, but I will be taking a look at a few key names here because, as I was saying on the Monday video, and also in yesterday's video, well, just be patient, let the market come to you, and you'd be surprised. A lot of these growth names, how fast they can sell off and how quickly they can come back into some support levels, which could free up some trades. And that's kind of exactly what's been happening all week. A lot of these fan favorite names or the high growth names, you know, they might have been up 20, 30, 40% in the last 2-3 weeks, but now just in 1 week, they're down 10, 15, possibly even 20%. So what goes up comes down sometimes just as fast. So we'll take a look at that section at the end of the video. And that's going to be it for today, guys. So let's jump right into the action, shall we? The SPY down about 0.46, the Q's down about 0.43, and overall, it just was not a very broad market. I mean, it was broad to the downside, but not so many names were green in the S&P today. A very big day of consolidation across the board, except for Apple and NVIDIA. They actually did well, but Microsoft, Oracle down 5.5, Amazon, Tesla, Google, Meta all down, software struggling as well. Financials, not the best day for financials. The banks were doing fine, but credit card companies, some of the insurance players, and some financial data corporations continue on their drawdowns. In terms of your healthcare sector, very bad day for healthcare in the markets today, really flushing a big level, still an accumulation trade, but this one is not going to be an easy one. They're not going to make it easy for you guys. I still think it's a great trade, but it might take a bit longer than people are expecting, kind of like bonds. And then to the bottom half of the market, we will have a look at the fact that, well, the rally in yields has been affecting all the things like industrials, consumer defenses, real estate and utilities have been pulling back as well. So really getting hit the hardest, in my opinion, over last week are some of the either high growth names or even some of the interest rate sensitive sectors. You can see that best on the 1-day relative performance. The only sector in the green today was energy. Everything else to the downside. Healthcare, the biggest loser here. Cyclicals, utilities, industrials, and everything under the sun was also red. On the 1-week relative performance, we've obviously undone a lot of the gains. And now after 3 days of consolidation, you have many more sectors in the red than in the green. To the downside, we are led by healthcare, communication services, which is largely Google and Meta, which have been selling off. Cyclicals, real estate, defensives, technology still holding some green on a 1-week relative. But other than that, it's just energy, utilities, and basic materials, right? So very mixed market right now, which also we can take a look at some of your market breadth. Market breadth right now is waning from the highs that we saw just a few short weeks ago. Percentage of stocks above their 50-day or above their 20-day EMA, very soft. 42% only. Definitely shows that we're in a bit of a corrective phase in the markets, not meaning the SPY and the QQQs are going for massive corrections, but it is indeed a very decent pullback, the likes of which we've seen many of in 2025. But this short-term momentum indicator is definitely very weak. Just goes to show you that more stocks are red than green, especially in the past 1 week of trading. Percentage of stocks above their 50-day EMA, that is still okay at 55%. Anything above 50 usually does show that the institutions are buying, although right now might be buying sparingly. And percentage of stocks above their 200-day EMA, arguably the strongest one. Well, we hit some highs of over 60% in the last few weeks, but you can see this is a weekly chart. We have not moved here in the last 3, 4, 5 weeks. A lot of AI-centric stocks have been moving really well, some data center plays, etc. But we really haven't seen some broad market expansion, right? Several sectors are just being left behind. And even within certain sectors, nothing is, everything is not equal. Like the financial sector, for example. The banks are doing well, but the credit card companies have all been down and consecutively down over the last few weeks. Insurance is still soft. Financial data is still soft. So even within certain sectors, this sector itself might be holding up well, but we don't have the market breadth that we would have had possibly 3, 4 weeks ago at this current time. So breadth is definitely taking a little bit of a hit. Just goes to show you that we are in pullback territory and we are going for some very healthy consolidation in these markets right now. Now, in terms of our earnings, guys, before we get into more technical analysis, we will do 2 company earnings, and I'll start off with Costco. No, not Micron right away. We're going to start off with Costco, guys. They reported earnings after the bell tonight. Well, essentially yesterday for me, but tonight for you guys. So essentially, guys, what we're looking at in Costco's price action, let me just turn on the extended trading hours, and you can see that Costco, unfortunately, is down roughly 1% after their earnings release. I mean, Costco, let's be honest, actually crushed it. They did a very nice beat on EPS here by 1.27%. and a 0.17 beat on revenue. Now, these numbers might not appear very large at a first glance, but when we break down the components of their earnings, you will see that they are very, very solid. So let's take a look here at some of the easy numbers for Costco. 8% growth in terms of net sales. That was fantastic. What a beautiful report by this company amidst all of the tariff uncertainty, of course. Comparable sales, we'll use adjusted because it strips out the impacts of foreign exchange and gasoline prices. Adjusted comparable sales, guys, 6.4%. That is absolutely amazing. Anything above 4% for big box retailers is very solid. 6.4 is at the top end of what you'd expect for a company like this. Comparable traffic up 3.7%. Adjusted comparable ticket 2.6% higher, and even e-commerce sales 13.5%. Costco's been doing a big push into e-commerce, and it has been paying off. Now, in terms of the breakdown across several different markets, if you look at adjusted comparable sales, US 6%, Canada 8.3%, very solid, and other international 7.2%. All these numbers very strong. The ticket sales across most major markets very strong. The traffic metrics across most major markets very strong. Just goes to show you how resilient of a company Costco is and how loyal the customer base is to the company as well. Net income also saw a 10.9% growth rate. Very strong. 3.1% net margins is the mark. Costco's never really been a bottom line net margin company. They focus most of their attention to top line revenue growth and customer acquisition and retention, which they're very good at overall. Speaking about that customer acquisition and retention, membership income growth, 14%. Now, the CEO did say that, Costco did raise prices last year. So how much of this membership growth is attributed to the price increases versus actual new members? Well, it's about half. Half of this membership income growth is because of the price increases last year. $5 for the normal membership, $10 for the executive membership, and the rest is just organic. Still very strong numbers with a 89.8% membership renewal rate, extremely strong. US and China renewal rate, 92.3%, extremely strong right there too. Now, we're sitting at 81 million paid memberships. That is 6.3% growth and 6.1% growth in total cardholders. Extremely, extremely strong metrics. And we already talked about the e-commerce comparable sales, which is very strong. The company's expanding into more opportunities for same-day delivery and using Instacart and Uber Eats as partnerships to kind of do that. And all in all, they're still opening a fair amount of stores. They'll be opening about 30-something new stores into 2026 as well. Very solid. So the company continues to expand its footprint, continues to acquire more members, and just continues to provide arguably the best value, right, for the best price in terms of the quality of the products that Costco offers, especially in food, but also in other miscellaneous items. Costco's known for that. They usually give very good value for the quantity or quality of the items that you're buying. Now, in terms of the earnings rundown here, you can see that Costco earnings tops earnings and revenue estimates as the Warehouse Club gains more members. Just a few key insights here from management. The CFO saying that the retailer has worked hard to offset the higher tariff costs. In some cases, it has introduced new items from its Kirkland Signature private label brand as alternatives to goods hit by tariffs. About a third of Costco's U.S. sales come from imported goods. Costco is also changing its merchandise assortment in some cases, he said, such as buying more US-made items or leaning into categories with less tariff exposure like health and beauty. So as we've been saying during this whole tariff situation, consumers also always have a choice, but corporations also have a choice, and that choice is what's known as the substitution effect, which is why I like this Trueflation Index measure the best, because it encompasses for substitution effects, right? You don't have to buy the products that are currently seeing inflation as a result of tariffs. And consumers are usually very good at pivoting their purchases and substituting those away. Moving on further, and companies are very good at that too, and Costco has a tremendous buy-side supplier team. Costco is also changing its merchandise assortment, you already read that. He said overall inflation, the CFO, remained in the low to mid-single-digit range, with food prices increases similar to last quarter. So still, saying inflation is not too much of a problem, same as last quarter. Yet, for the second consecutive quarter, he said inflation returned for non-food merchandise, primarily driven by imported items, largely apparel, guys. Apparel and some furniture items, but we already knew that. So no secret there. As U.S. consumers look for value, Costco and its Warehouse Club competitors have opened new locations and attracted more members. Younger shoppers have signed up for the stores as the retailers offer more convenient ways to shop online, a wider variety of merchandise, and cheaper meals. Here's what the CEO had to say. The average age, or rather the CFO, the average age of the company's members has fallen, which is a good thing. And just under half of its new signups each year are from people under the age of 40. In the quarter, its membership fee jumped about 14%, which reflects its increase in paying shoppers, the rising number of members who are upgrading to higher tier memberships, and its higher annual fees. On the company's earnings call, the CEO said that Costco opened 27 new warehouses this year, and it plans to open another 35 next year as well. During the quarter, sales in Costco's fresh category, which includes perishable items, grew by high single digits, led by double-digit gains in meat. Now, non-food items grew by high single digits too, and that is in spite of some of these products being hit by inflation, although Costco does a good job of swapping those out and finding the best value possible for you. And those items are such items as jewelry, gift cards, toys, and men's apparel, which all rose by double digits year over year. So all in all, guys, in my opinion, a very strong quarter by a very resilient company. Now, right now, the next question you should be asking is at 943, is the company a decent buy? Well, we all know that Costco trades rich, but Costco trades rich for a few key specific reasons. Now, arguably, right, you can say that maybe it shouldn't trade this rich, but this is the price that the market is currently giving it, above a 40 price to earnings ratio, because of the membership consistency, because of the same store growth consistency, because of the fact that they continue to open new locations, and every time they do, they're always as packed as the most recent locations that they have opened in the past. That being said, the company is extremely resilient with a very large consumer base, and they do have recurring subscription revenue. Although it's not that much of a component of revenue, it definitely helps drive margins to the bottom line. which is what Costco can use to kind of offset some of its efforts into trying to bring you the biggest value, right? So that's what Costco tries to do. If they can source an item for $10, they'll want to sell it to you for as cheap as possible above their cost. That way you come back to their store, you feel that you're getting good value, and they can charge you the membership fee. The membership fee is really where they make the most of their profit margins. They don't try to mark up food and other apparel by a substantial amount. They really want to drive that top line revenue growth by having more members, more people in their stores, and more purchases per member. EPS, very steady and consistent, which is another reason why this company benefits from higher valuations. And revenue, also very consistent too. Kind of looks like Walmart, right? But I do believe that Costco provides better value for quantity than Walmart, and especially better quality for value than Walmart as well. That being said, the stock currently trades right now at a 46.9 forward price to earnings ratio. If you use the PEG ratio, you might think that, whoa, this is a little bit high, right? And that would be true because they're not growing EPS that substantially per year. But a better metric for some of the big box retailers that don't have the most fantastic earnings per share or rather profitability metrics because they are top line growth revenue companies, price to sales is 1.41. That's very fair in my opinion, but the free cash flow yield is a little bit low. So all in all, guys, the analysis on Costco is it's still the same fantastic company that it's always been, but it just always depends how much are you willing to pay for the quality of this company. Obviously, the market has given this company a premium valuation over some of its peers, and it's done that for the last, well, as far as I can remember, the last 6, 7, 8, 9 years at this point in time. I still believe that Costco buys up here can be very rewarding, especially down here in the 920 down to 875 area of support, but even some slight nibbles in this location, not very bad in my opinion. The company largely has been consolidating in this very wide range for approximately the last year. It's definitely not a massive weekly uptrend, is it, right? It's more an area of sideways price action and consolidation, similar to the one that we saw back here. And this is usually what Costco does. It gains momentum, goes on tremendous rallies, and then when the valuation gets a little bit frothy, it tends to go on these extended consolidation periods. But I do believe this is a fantastic company to own for the long term, and I am currently picking up a tiny fraction of a few more shares. The bulk of my position is already built, but I do believe Costco is an extremely strong bet. Them and Walmart and of course Amazon are probably my 3 favorite companies to own in this current space, which is big box commerce, right? But Costco, phenomenal company, probably one of my favorite companies in terms of the brand value, right? And their value proposition for consumers. Consumers really like this one a lot, and I do too. So that's everything we had for the Costco earnings breakdown. Hopefully you enjoyed that. Now let's kind of switch gears here and jump into something a little bit different. And we're going to be looking into Micron. So Micron had their earnings a few days ago, but we're going to be covering them today. So as we saw, Micron, since their earnings, is down about 5 to 6%. But it's not because they didn't have good earnings. They had great earnings, as a matter of fact. Let me show you. In terms of the EPS beat, a very cool 6% EPS beat and almost a 1% beat on revenue, so double beat. But the benefit of the earnings was not so much in this quarter's numbers, it really was in the guidance. Take a look at the Micron guidance, guys. Some of the easy numbers here. Tremendous guidance, 12.5 billion versus the 11.8 estimate. That's a big beat on Q1 revenue guidance. And also look at your earnings before interest and taxes, 5.1. So not only driving more sales, driving more money to earnings, more profitability metrics for the company. And EPS, look at this massive 20+% EPS beat on the guide, 3.75 versus the 3.04% estimate. That is fantastic. Now, arguably, if the company hadn't already ran, something like 40-50% in the last 3 weeks into its earnings, it probably would have exploded on those numbers alone, just from the profitability metrics and just from the guidance. However, as we've seen many times over the course of the last few quarters, if something runs too much into earnings, even if it has phenomenal earnings, guys, sometimes people argue, well, it's kind of already priced in and you will not find any net new buyers up there. And in my opinion, that's exactly what happened with Micron. But it's not because they had bad earnings. Look at the revenue numbers, 46% year over year. They absolutely crushed it. Gross income, 83% year over year. Look at the size of these beats on gross income. Insane, right? Operating income, 127% year over year. So as I said, not only benefiting from the data center AI ramp in their high bandwidth memory offerings, every single component of the business firing on all cylinders. The company has pricing power as well. It has probably the top offerings in its segment. It does compete with SK Hynix and Samsung in a few key lines of business there, but they do arguably have the best products, and the pricing power that they have definitely reflects that. They're able to charge a bit of a premium, especially for their memory offerings, which is the bulk of their business, of course, right? Well, it's their entire business. That being said, guys, operating margins almost 40%. Super big rally here from at this same time last year, and EPS, phenomenal beat on EPS for Micron. So let's dive into some of the article right here. Micron beats on earnings as the company sales rise 46% on the AI boom. The Micron CEO had to say, as the only US-based memory manufacturer, Micron is uniquely positioned to capitalize on the AI opportunity ahead. Micron's largest unit, which sells memory for cloud providers, reported $4.54 billion in sales during the quarter, more than tripling on a year-over-year basis. Sadly, that's it for the article, guys. A very short article, so I guess CNBC doesn't dive as deep as they do into Costco, at least not for Micron, but that's why we're going to pull up the earnings presentation here, and let me show you what a fantastic quarter Micron just had. So we're going to start it off, guys. We know that the data center business crushed it. They have industry-leading technology, and the inventory levels are very good right now, which I'll remind you was a problem earlier, right? So in 2023 and early 2024, I'll remind you what was affecting some of these semiconductor companies, right? Especially Micron, because they don't only do memory for data centers. They do have 6 huge partnerships for data centers right now, but also we had the smartphone and PC slowdown. We had the China firms that were banned from buying. We had the huge capex for new factories on Micron, and we had rising inventory levels as people were just not looking to, just basically refresh their inventories. People were sitting on a lot of inventory from 2021 to 2022, and they had to liquidate it pretty much, right? Or had to put it into products, namely in smartphones, PCs, and especially automotive, industrial, and embedded applications, which is a decent component of Micron's business. So although the data center business is crushing it for them, we don't really have to talk about that. I mean, some metrics are just ridiculous, like, Micron's server aspect here at 50 server RAM had 50% sequential growth in the quarter, record revenues, partnerships with NVIDIA all over the place. So we don't really need to spend too much time on the data center side of things. We know they absolutely crushed it. The one thing that has always been a red flag for Micron in the last 2 years has been the other lines of business, right? So let's have a look at the other lines of business, because those, prior to this AI boom, those were the only reasons, or rather the major reasons, why the stock had very lumpy EPS. See this big drop off on EPS right here? Took a couple of years to recover. See this big drop off on revenue here as well? Well, that's the other component. So we want to seek to understand, well, even though Micron is really printing on the data center side of the business, do they have the other lines of business starting to come around and support them? And the answer, as a matter of fact, is starting to be more yes than no. Finally, we've been waiting on the channel for like 12 to 18 months for this to happen, and arguably it's finally here. So PCs, a big component of the business. I'll show you the numbers. We expect PC unit shipments to grow at mid-single-digit percentage levels in 2025 versus our low single-digit percentage growth expectations previously. So PCs on the up and coming, right? Back. Finally, from 2021, 2022, we're finally starting to come back for PCs, of course, because of the AI-enabled adoption and the requirements for more RAM. In terms of mobile and smartphones, that's been very soft for this company in the last 2-3 years. Is it coming back? Yeah, notably 1/3 of the flagship smartphone shipped in Q2 contained 12 gigabytes or more. And given recent product launches from Apple, Samsung, and other smartphone OEMs, we expect this mix to increase over the coming quarters. Finally, some good news for mobile. We know that one's been slacking for the better part of the last year and a half. Automotive and embedded, how is that one doing? In automotive, AI-enhanced in-cabin experiences require significantly higher memory and storage content, making it a higher growth part of the industry. The auto sector even coming back now. In embedded, we expect physical AI such as drones, advanced robots, and AR/VR to become a more important driver of demand over time. Automotive and industrial demand strengthened throughout the quarter, exceeding our initial forecast. So finally, finally Micron acting like the broad company that it once was. Well, these companies go through a lot of cyclicality, guys. It's very normal, but now we have more sectors participating than only data centers. It really just reiterates the bullish thesis behind this company. So fiscal 2025 quarter revenue, we already talked about it, 46%, but they just ended their actual fiscal year, 49% revenue fiscal year 2025 for them. Very strong, right? DRAM, 62% year over year. Fantastic. And for the entire fiscal year calendar, NAND revenue increasing 18%. I'll remind you that DRAM is 76% of total revenue, and then NAND is 23%. Both firing on full cylinders here. This is the most important chart in my humble opinion, guys, because we see a few key components. All lines of the business are going higher and substantially higher. Cloud memory, a lot higher. This is the big revenue driver. Think of everything that they're doing for data center providers. 6-bit contracts. You can probably assume who they are, right? NVIDIA, AMD, and then some of the other hyperscalers, of course. Core data. Now this one up slightly, but I want you guys to notice the improvements in margins in relation to the last quarter specifically, and sometimes in relation to last year as a whole. Look at the margin expansions for cloud memory, 59% here, gross margins, and even operating margins. Look at the expansions here. So more money, more profits. Mobile and client, revenue, significant uptick in revenue right here, and significant upticks in margins, both on a quarter-over-quarter comparison for last quarter, but also in terms of year over year. And now auto and embedded, same concept. Very strong revenue increase here in relation to last year. However, also what we're seeing, guys, is gross margin expansion too. Very solid metrics for Micron. Nothing really bad to say about the company at all. But of course, a lot of that was driven by their data center, which was 40% of company revenue. Well, they have two different lines of business. They actually have data center applications, but then the cloud memory business unit is the really one that's exposed the most to what you guys and what we know commonly as data center quote unquote revenue. 4.5 billion. 40% of total company revenue. But we know that, right? 34% up sequentially is that whole segment of the revenue, with HBM revenues reaching new quarterly records. But we don't have to talk about that. We know that that was the thesis behind Micron, which is why I bought this company way down here around 70 bucks. And I had that thesis as well. I'm saying this company is just underappreciated for the amount of money that will be driven towards them because of this AI narrative, right? Now, that being said, I know what we're probably thinking, right? Micron has run an absolute ton. At 156, is this company still a buy? Well, we have to go through a few assumptions first, right? Some of the assumptions are the fact that they will be increasing EPS by a substantial amount. But you can see the numbers are very lumpy here, right? Not very consistent. And in 2028, analysts are very mixed. So, it's not a very consistent EPS growth rate here. As you can see, it's doubling into next year and then slowing down. And then some analysts even have penciled in a bit of a decline in 2028, which I don't personally agree with, but these are the trading view numbers. Now, I had to go through many different sources, but this is the easiest one that I can show you. But average analyst targets and FactSet data research does show that we do have some nice expansion through 2028, 2029. However, it'll be going like this and then tapering off, a bit like NVIDIA, right? So starting especially with the data center centric portion of their business, starting at 40, then 37, then 32, and then slowly making its way down to low teens by 2030. So the growth rates are going to be slowing, as of course it's very natural, but they're still high. Revenue growth rates, same concept. Huge increases in revenues up front, but then slowing down a little bit. As a result, after a lot of digging, I feel that it's fair to give this company a 15% annual revenue growth rate through 2028 and a 15% average annual growth rate through 2028 for EPS as well. That being said, the analyst consensus are a lot higher. Revenue is actually closer to 20% and EPS growth rates are closer to 18%. But I'm going to taper back expectations a little bit just because they're very lumpy and we're still unsure whether or not, how hard the rest of their segments are going to come back and whether or not they can sustain the ramp, the speed at which they're ramping the cloud memory revenue numbers. So I'm even tapering back the expectations, but I'm going to show you guys why I do that, okay? even if I taper back the expectations in relation to what the street is forecasting, look at the forward price to earnings for 2026. It's a 9.87. Now, that has nothing to do with my estimates. Those are just the EPS estimates from the company. 9.87 price to earnings, super cheap. But the PEG ratio is important. That's when you use the EPS growth rate. If you use a 15% EPS growth rate, which is on the softer side of things, right? I'm discounting the fact that we have a 2x increase here from this year to next year, which is massive. And I'm just streamlining this quick expansion into slower expansion into 2028. Let's just say if the numbers work with 15, they'll work for a lot more. And they definitely work with 15. 0.65 PEG, which is extremely cheap, and a 3.3 price to sales ratio. All metrics point to the fact that this company is still very cheap and can possibly have a lot to go. And as you can see from the average price target estimates, we're looking at between 186 to the top line level of 250, to where the valuation would still make sense. But obviously this company doesn't have the most consistent revenue streams. It's a very cyclical business, and it highly depends on the further expansion of the AI narrative, which I don't think will be a problem, but it also depends on the further recovery of the mobile and client segment and the auto and embedded segments as well, as they do represent a decent portion of Micron's revenue, as you can clearly see from these numbers, right? Just over half the revenue, as a matter of fact, or slightly under half, my mistake. So that being said, guys, that's it for Micron. Is the stock a buy here? The stock is only a buy up here, guys. Keep in mind, we're tremendously extended here on the time frames. In terms of the weekly, we're very far away from the weekly 12 EMA. In terms of the daily was almost vertical leading into these earnings with good reason, because the earnings were going to be good and the guidance was great. The monthly chart is also very extended from the 12. So Micron is only a buy here. Well, fundamentally, if you just close your eyes and don't look at the chart and you're into it for the next 2-3 years, the valuation makes perfect sense. However, if we're looking for optimal entries, because you guys know I love looking for optimal entries, 130 to 120 on any market consolidation. If it comes down there, if we are accumulating some swing trades from here with profit targets in the mid 200 range over the next few years type of thing, whether that's with call options, leap call options 2027 type plays, if we're buying here extended like this, we have to be willing to DCA into the logical support range. We know the price is cheap right now, but we also know the chart is extended. So that being said, it is a nice location to start some positions because the stock can just keep running because the fundamentals do support a further run because they're still cheap. But the technicals are telling us we might be a little bit extended right now, and before a next rally, we could just consolidate a little bit and then go for the other leg of expansion. So I am still a fan of accumulating some here, but with the idea of needing to DCA if we do pull back into the 130, 120 range. And that is my analysis on Micron. Hopefully you guys enjoyed that. Bit of a tough company to do fundamentals on because the revenue and EPS streams are just so lumpy because of their various lines of business. But I went very conservative with my estimates, and you guys know the drill. If the numbers work with consistent conservative estimates, well, of course, they're going to work with more bullish estimates. So that being said, that's everything I had for you guys today. Now let's dive into some of our charts, shall we? All right, so taking a look at the SPY right now, the SPY down 0.46% today, of course, and we are challenging the line in the sand level. Let me put a nice little line right there so you guys understand that we are challenging the daily higher lows. So we had the nice daily uptrend right now, but it is being challenged. One more red day and flush this area right here, 654.5, and you have officially lost your daily uptrend for the first time in quite a while, guys. We have not lost the daily uptrend so far in months at this point in time. And if we do that leading into the end of the month of September and the early portion of the month of October, you guys know the drill. Late September, early October can be a little bit bumpy, and even mid-October can be bumpy. So if we did have one time to consolidate these markets prior to the infamous Q4 rally, well, this might just be the time. But just pay attention to it, not trying to predict. We will just react to the price action. In the event you unwind and go for the daily downtrend, a few key levels to react from: 651 and a 647. Nice, tiny little shelf area for the bulls. However, if the consolidation lasts for more than that, you will be going for the inevitable weekly consolidation. It's going to happen at one point in time, guys. These weekly downswings are quite a normal time of price action in the market, and this time would be no different. 634 are your weekly higher lows. You could just be looking for a few weeks of consolidation down at these levels and maybe get ready into the mid to end of October for the start of the Q4 rally. That being said, the markets aren't looking too bad, but this is the time to be building that shopping list, and all the names that have ran a lot since you've been looking at them. If you've been looking for pullbacks, identify your locations and just be ready to strike when the iron is hot. Moving on to the QQQs right now, not quite losing the line in the sand levels just yet on the Qs. That would be 584.21. Still a very nice daily uptrend, but similar concept to the SPY. If you give it all back and more and set up with the daily downtrend, you guys know the drill. Possibly up for some weekly consolidation. 582 down to 575. And that being said, that's the shorter term support range, which was prior resistance. The larger one, of course, is down here about 560. So as you can clearly see, the bulls are working with a tremendous amount of space for the weekly consolidation. We will just see if it happens. Now, moving on to our XLF Financials Index real quick. Well, we can see that the Financials Index is not moving the best, right? A lot of push and pull. The banks were doing good, but even the banks, right, starting to look a little bit top heavy right now on JP Morgan, on names like Goldman Sachs. We might just be heading into a bit of a leg of consolidation. Other names in the sector have already been consolidating, such as MasterCard, which in my opinion is a great pickup right now. We can talk about Visa, which is a phenomenal pickup between the 340 and 330 levels, and even names that have ran a ton, like American Express, consolidating a little bit too. And even some of the other names like Berkshire in the financials landscape, right? Still a little bit soft, still trying to go for that second leg of expansion. Clearest time frames, in my opinion, is the weekly, looking for the eventual weekly recovery rally here. And thereafter, we can, of course, talk about these names that have done nothing but go down and down and down. SPGI, phenomenal pickup down here in the 485 range. Moody's Corporation, also a great pickup as well down here, 467. Can talk about names like FICO, phenomenal pickup down here in the 1500, 1400, even lower. This entire range of consolidation, FICO is still down year to date. If you have a look, 22%. Very decent buy in my opinion. Names like Equifax as well in this landscape, phenomenal pickup down there. And even a name like FactSet, phenomenal pickup down here on FactSet. FactSet has never been this oversold ever on the weekly time frame in company history. FactSet also has never been this monthly oversold in company history. Definitely a historical pickup area for this company, but as of right now, it is still a falling knife. I do truly believe that all buys down here will be rewarded eventually. It just might be very bumpy in the process. So there are a lot of phenomenal buys across the financial landscape. You don't only have to look at the banks. Moving on to healthcare right now. Healthcare really breaking down. They hovered around here for the past, 3 weeks, and now sadly breaking down. Daily downtrend clear as day right now on healthcare, going for more of a weekly retracement. They tried to build a little bit of a shelf right here. The bulls were looking good to go for the expansion, and unfortunately the market said absolutely not. So as of right now, we are still in very awkward monthly consolidation. Not getting the leg of expansion just yet. We will have to wait a little bit longer for that. Excuse me. Somebody apparently is doing construction in the condo above me. So we'll kind of trying to kind of get that back. So healthcare overall, not looking the worst, guys, but we are looking for the eventual leg of expansion sometime down the road. Still a phenomenal area to be possibly accumulating some shares. Now, moving into semiconductors. Semiconductors roughly flat on the day, but it's not without saying that they weren't down a lot more, right? The semiconductor landscape was down almost 2% today before recovering. This one is still in a very clear daily uptrend with a lot of space to work with. Currently still backtesting the 12 EMA. The daily higher low is all the way down here at 301.22, so the bull's working with a lot of space, but in the event that the bullishness turns into short-term bearishness, daily downtrend into consolidation, understand who's in control here. The weekly bulls are in very clear control, looking for a weekly higher low. At this point, the pullback area would be that infamous 300 down to about 295. Beautiful breakout retest category. Possibly on the table right now for a possible swing trade if it happens. Moving on to the Russell right now. 0.96% to the downside. Unfortunate, but still not too bad. Looking good, but now unwinding, right? Line in the sand is currently right here at 236.94, 237. So that being said, if you lose this and unwind, you might just be heading for the infamous daily downtrend that I've been waiting for, which would be synonymous with a healthy weekly pullback. It's to mean nothing but going up over the last, 2 months? If we get a pullback coming down into this 232 down to 225, I will probably be opening some swing trades for the infamous breakout retest trade. Not looking too bad on the Russell right there. Now, that being said, we can take a look at the VIX. The VIX has been expanding for no real reason whatsoever. Just a bit of volatility momentum in the markets right now, but fantastic opportunities on these spikes to be selling some puts. Our group found some phenomenal opportunities this entire week, really far away from current market prices just because of the slight expansion in the volatility that we see very early in the morning. That being said, the VIX is still low. Just pay attention to that volatility expansion. It'll be phenomenal for selling options. The yields we've talked about all week, for the last 2 weeks since the Fed cut interest rates, and the 10 and 20-year yields have done nothing but go up. Once again, as I was explaining in the intro, basically the bond traders and the bond vigilantes trying to call the bluff, saying, listen, you guys are cutting interest rates, but the economy is still too strong to warrant these interest rate cuts, and inflation is still too high. So maybe you guys should leave them higher for longer. That's what the bond traders are saying. But eventually there will be enough pressure with enough interest rate cuts to bring down the longer term yields, which in turn will also cause the longer term bonds to start their inevitable rally, in my opinion. So this trade has been a very slow mover, but I think it's looking fairly good into the end of the year and into 2026 as well. So keep that in mind. It's just going to be slow. Gold also, yesterday, not a very bad day. The bulls are just still consolidating a little bit sideways. We were noticing, obviously, recently that they were very extended on most timeframes, especially the daily timeframe being very overbought right now. And the weekly time frame once again peeking its head into weekly overbought conditions. That being said, gold is very extended. Swing trade longs right now need to be done carefully. The stop loss for any swing trade longs from here would be 37.14, and your upside expansion targets would be something like 38, 38.50 psychological round numbers, of course, as the daily bulls still control this trend. However, in the event that we break down, you might just be looking for the infamous daily trend rollover. Something like this maybe, and then thereafter you're going to be looking for much needed weekly consolidation. In my opinion, for any larger gold trades, we should be looking for weekly consolidation, maybe bringing us back down into the 12 EMA around $3,500 levels. Moving into crypto right now, crypto had an absolute brutal day yesterday. Bitcoin was down 3.8%, and the altcoins were down even more. But we know that the bears have been in short-term control of this trade for the last 2 weeks. Rejected at 120. And now we are currently coming down a little bit hard, daily downtrend, and possibly just going into another leg of weekly consolidation. It has been a weekly downtrend that the bulls have sought to get back, but we're unable to do so. So in the event this leg of downside continues, I'll remind you, same support levels as always, 107 down to about 100. I will be accumulating more Bitcoin down here and selling some put options as well to kind of gain some very juicy premium in that level. In terms of Ethereum, Ethereum having a very bad day yesterday, of course, down 6.71%. And the daily downtrend was already started, so it should be no secret. And we've been calling out this retest area for, I would say, the last, 4, 5, 6 weeks at this point in time. Weekly downtrend finally coming down, back testing our 4,000 to 3,700 range. This could be a very nice area for accumulation. Talking about accumulation, just building some long swing trade positions in these levels would be fairly decent. Overall, 4,000 out of 3,700 is going to be the mark, as I will remind you, of course. And in the event you break even lower, I'll remind you what we're trying to go for here. Just some very healthy monthly consolidation. If you lose 37, you're arguably coming back down to 33, 32. This entire range of accumulation is decent if we're looking for longer term Ethereum positions. Now let's move into our big tech names. Sorry for the construction, guys. I don't know what's going on above me, but it shouldn't be happening. But let's just get into it, shall we? So Apple about 1.81%, really bucking the trend of everything else being down today. Apple super strong, but very tough to position up here, and it's off the back of the iPhone 17 sales, as we were kind of trying to predict and anticipate that back here, this back test of this nice support range would be a very nice catalyst for some expansion in the event the September 7th rollout of the iPhone 17 would be well received. And that's exactly what happened. But right now we're approaching the final take profit target for any swing trades, 260 all-time highs, looking very good. Very good sales numbers for Apple's, just very tough to position up here, both in terms of acquiring shares for the long term. Shares for the long term, we were very clear. Down here was the last area that the valuation valuation made sense, even with the low revenue growth rates, if you were anticipating higher revenue growth rates in the future. And that's also the last location that large swing trades such as leap call options made sense. There were some temporary swing trades that were available here for forward price targets of up here with a stop loss all the way down below there. And now those two have been completed. So essentially, there's no more thesis for Apple swing trades in my humble opinion. Your opinion may differ, of course, but I am all out of my Apple swing trades as of right now. Moving on to AMD. AMD still doing a whole lot of nothing, but that is very advantageous for those of us that enjoy selling put options. This area down below here, 147 to 133, phenomenal area to be targeting for some short puts in terms of swing trades. In terms of the daily price action, very choppy and getting rejected at resistance, 170 down to about 157. That being said, the weekly is still looking very soft. So in the event we keep consolidating or even go into a weekly downtrend and plunge into the 140 area, guys, at the end of the day, we're just looking for a monthly higher low, right? It's very possible we found it already, or it's very possible we go a little bit lower. So the way that I'm playing this one is I'm accumulating some positions here, but I will not hesitate to accumulate more positions down there as well, as I do believe the next legs of upswing for AMD can be very, very violent, just as the first one was, as the valuation right now definitely supports a lot of upside expansion. On to Amazon. Amazon down how much? A lot over the course of the past 5 days, right? 7%, 7.5% overall. Phenomenal buying opportunity in this region, both for long-term shares, but also for selling put options as well. Your next area of support is down here, 212 all the way down to about 207. That's going to be a little pocket. Sadly, we have lost the weekly uptrend at this current stage, which just means that we're into more monthly consolidation for the stock, just looking for eventual monthly higher lows for possible further trend continuation. Amazon, probably one of my favorite stocks in the entire market right now. The valuation does support expansion. All lines of business are currently firing on all cylinders. And Amazon, I'll remind you, is the last remaining stock that is underperforming this year, okay? It used to be Apple. You remember a few weeks ago when Apple was down 20% year to date and I was saying probably one of the best buys in the market? You remember a few months ago when I was saying Google, probably one of the best buys in the market because it was lagging behind? Well, now one after the other, they're kind of bidding these stocks higher. Google now up 30 year to date. Apple went from minus 20 to plus 2. That's a big swing in the last few months. Now, the last remaining play is Amazon, and arguably one of my favorite plays in terms of how well all their business is doing, right? So, big fan, shares, leap call options, but also short puts under the market could be very rewarding given enough time. Moving on to Google right now. Google down about 0.51%. No secret there. We are currently consolidating. We've now lost the daily uptrend. The higher lows were set right about there, 246, and now we're currently unwinding that. Loss of the daily uptrend in the event you go for the daily downtrend shift. I'll just remind you what we are looking for on Google here. A very natural pullback cycle after ridiculous upswings here. Finally on Google, just a little bit of profit taking in the event that I can find this one back in the 220 range along with the 12 EMA and cool off these weekly RSI metrics. I might be interested in playing this one again, but as of right now, I wound down all of my Google leap call contracts at 250, which was my price target, but not even for this year. That was my price target on Google for next year. So winding it down in the event we find some monthly consolidation or weekly consolidation, you might see me play this one again, but I'm still holding every single one of my long-term shares, of course. Moving on to Meta right now. Meta down 1.54% overall. Not the worst day on Meta, but they are challenging these lows, right? The line in the sand level is right here, guys, 743. If you lose that, you lose the daily uptrend, and you might just be going down to test the infamous location that we've backtested several times. Prior all-time highs, this infamous, 730 to 720 pocket could be the next stop for the bears. Your weekly higher lows are also down there as well. 720 is going to be the mark. Meta, although not the clearest setup for some swing trades because we're kind of doing a whole bunch of nothing at these levels since after earnings, right? Meta's just been doing nothing. We had the 11% pop after earnings and then absolutely no follow through since the month of July. Now, that being said, Meta is still a nice stock to be accumulating in these ranges. 760, the valuation is not too bad, but push it down to 700 and my buys become a bit more heavy. But I am a fan of buying a bit more Meta stock in these locations. I think they'll have a phenomenal end of the year and Q1 2026 as well. Moving on to Microsoft right now. Microsoft actually cracked the daily higher lows, sadly, right? So you could argue if Microsoft is also down tomorrow again, daily downtrend. If you get the daily downtrend, this was a nice attempt by the bulls to change the trend. Nice attempt to push a little bit higher on this weekly retracement. If you get the daily downtrend though, that's the weekly lower high, and you might just be going down a bit lower. And the retracement size right now on Microsoft, very soft, 38.2%, which gives the bears a lot of opportunities and a lot of probabilities to test these lows again, or maybe go even lower. In the event that that does happen, I'll be a big fan of playing the monthly higher low retracement on Microsoft right there, possibly coming down to like the 465, 450 area. If we see that, I've been waiting to play Microsoft down there for a while. If they come into me, I definitely will be, but that's why I always say, let the market come to you, right? The market came to me several times in 2024 and 2025, and I bought the dip heavy down there. Now, I haven't done any buying all the way up here, and I'm very patient, right? If Microsoft doesn't offer me more buys, no problem. There's tons of other stocks that are offering me more buys, which is why I'm never only married to one company. Moving on to Netflix right now. Netflix, I mean, still the same magnet area, 1210 down to 1185. I don't know how many times I've referenced this range in the past 2 months of trading, but it's just sticking here, right? Line in the sand is below 1180, cracked 1180, and sadly, you are now losing your weekly uptrend attempt from the bulls, and you're going into more monthly consolidation as well. The bottom end target would probably be down here, 1100 to around 1050, just joining back with the 12 EMA on the monthly. This has always been a nice backtest location for the bulls. You can see it almost every single time. If they do it again, that's the next location I'll be buying some Netflix shares. Moving on to NVIDIA right now, NVIDIA up 0.41%. I mean, they were down like 1.5% at one point today before recovering a little bit, but they did give back all of the bullish news from the OpenAI event on Monday, right? So unfortunately, NVIDIA giving back most of that news, but not giving back the price action levels. Still a daily uptrend as it stands right now. The higher lows are set 168 and very nice support below 171 down to about 165. That being said, if you unwind without any new highs and you flush these lows in the next few weeks, you guys know what to expect. If the SPY, the QQQs go into weekly consolidation, NVIDIA might follow. That would be a weekly downtrend and would be a phenomenal area for a bit of monthly pullback. So I'll be a big fan of selling some put options again into the mid 150 range, playing this NVIDIA pullback. The earnings were fantastic. Demand is very strong, but right now just not expanding in terms of price. So very decent area, guys, to be building some further share positions or some further swing trade positions into either support lows or even all the way down to the actual larger support level 150. We want to be playing these monthly consolidation phases on NVIDIA because usually they always end up in the same fashion with another very strong leg to the upside. Moving on to Tesla right now. Tesla down 4.38, but let's be honest, the bulls are still holding fairly strong. We had a very nice breakout right there. In terms of the clearest time frame, in my opinion, it's the weekly, right? Beautiful weekly leg of expansion smashed through 2 resistance ranges. And now if the market gets a little bit soft, you might be looking to backtest the higher one, 405 down to about 381. This would be the backtest location. If you get a big and fast move down into there, well, possibly selling some put options down here is not the worst proposition because you have an extra level to kind of base your price action ranges off of. Tesla right now, though, a little bit too high, in my opinion, for some swing trades for some further longs. In the event we backtest some support ranges, though, we could possibly re-explore this trade. Moving on to Palantir right now. Palantir down about 0.25%. Sorry, I'm going a little bit fast right now because I want to get into the biggest gainers and losers of the day section, and I don't, without the video being 2 hours long. Palantir right now consolidating a little bit. Daily option is nice, looking for the daily higher low. The higher lows are right here, 160-150. That being said, the bulls are still looking in good shape, right? But if we unwind a bit more with some market consolidation and we undo this daily option and go into daily downtrend, the bulls, what they're going to be looking to do here is just probably do some sideways accumulation, right? Either a tightening range bull flag like this or something of that nature. That being said, Palantir is still looking good. We have not lost any time frames, but if we do get some extended consolidation because we're trying to grow into the valuation, that would not be the strangest thing. Now, Palantir has been doing a wonderful job of acquiring more government contracts in the most recent few weeks. It seems as though every few days we get new Palantir announcements about new contracts, but as you've seen, right? the news hasn't been hitting the same. And that's because the stock is very expensive right now, but also because the market is not in full bull expansion mode, at least not anymore as it was a few weeks ago. So we might just be approaching a more further consolidation phase on Palantir. So watch out for that. Moving on to SOFI right now, SOFI down 1.13%, but at one point today, SOFI was down 4%. And there was a great opportunity to sell some puts down here. 25, 24, even 23.5 for next week. That would be a huge decline. The VIX definitely helped with that this morning. So myself and all our Discord members were able to get some really good trades on SOFI in this location for next week in terms of selling puts. That being said, the daily uptrend is still in full bull control. Higher lows are right here, 26.20. In the event that you give this back and roll over, it should be notable to you, right? Because we have not lost this 12 EMA for a very long time on SOFI. So in the event that you lose it, you're going into weekly consolidation, and that would just be healthy in my opinion. The bulls, very strong weekly pushes here. Any consolidation might bring you back into the mid 25-24 pocket, which is the infamous next area of support. So keep that in mind. Moving on to Uber right now. Uber, very choppy price action as well. The daily bulls are still in full control of this chart, but looking a little bit soft with the rest of the market in the most recent few days. That being said, phenomenal support back down here, 93 to 90. If we approach this range, I might be looking to sell puts under the range, talking about under 90, as the valuation definitely is pretty cheap down there, all things considered. It's like a one peg. So no swing trade longs for me on Uber from up here. But if we come back down into support, I may just consider it, as there's an easier stop loss level to be had down there, and also selling some puts below with a decent valuation. And lastly, TSM, Taiwan Semiconductor, pulling back a lot from its most recent highs, but the bulls, every pullback, try to play some defense early morning, right? But the bears right now, a bit too strong. That being said, who's in control of this chart? Well, obviously, let me just draw this line properly. Obviously, the bulls. Beautiful daily uptrend, looking for some higher lows. A line in the sand down here, 258. Anything above that, looking for a new higher low for further trend continuation, but daily RSI, a little bit high right now. Weekly RSI, a little bit high right now. So in the event we give this entire move back and go for a bit of a bear move down, well, you're just going to be looking for a very natural and healthy weekly leg of consolidation, and that might bring you down into the 250 down to 240 range, which is the infamous backtest range, and the 12 EMA on the weekly. It would be great consolidation, and one that I would be looking to play, and maybe one where I'd be looking to accumulate a couple more shares of TSM. Sadly for me up here, it is blown past a lot of the technical levels I was looking for, and also the valuation is not considerably cheap anymore at 277, so you will have to give me a better price to participate with some swing trades or some short puts or some more long-term shares. I was buying TSM this entire time. I mean, I've been buying TSM for a long time, guys, but I was a big fan. The last time I was buying TSM, consolidation was down here, but eventually you got to draw the line somewhere, and now the line has been drawn, at least for me, on TSM, but the company still has phenomenal growth prospects in the future, and obviously phenomenal fundamentals. Nobody is questioning that. It's just the current price. Sometimes you got to draw the line somewhere, right? That's everything for our stock market rundown. Hopefully you guys enjoyed. Now, let us dive into some of the biggest gainers and losers of the day. Okay, so instead of going through this entire list in, descending order as we usually do, I'm just going to point out some of the names that I am currently accumulating and currently interested in. Number one is going to be MSTR. MSTR down here in the sub 300 range as Bitcoin consolidates is a very decent opportunity in my opinion. 300 down to roughly 260. This whole range, I started buying MSTR here. I'm currently going to buy a little bit more, and the final buys would come in all the way down there, looking for the next big leg of Bitcoin expansion, right? If you cannot hold this play for at least the next 6, 9, 12, 18 months, looking for the next big leg of Bitcoin expansion, then the play is probably not for you, as currently we have broken through the last line of defense for support. So obviously, short-term swing trade longs are off the table as the bears control the shorter-term time frames. However, for the longer duration accumulation phase, it's still good. And yes, indeed, this is Michael Saylor, at the time when he used to work for McDonald's way back in the day. Just figured I should throw that out there. Circle, not a bad opportunity as well. I am looking to accumulate some further positions. And the last time I was buying some positions was down here on Circle. The forward thesis for the bull and base case scenarios is very clear in my humble opinion. Looking for some big share price appreciation over the next few years. I will be a big fan of playing this one, at least accumulating some shares down here, but even selling some put options at the lower levels down there. Not the worst proposition. Another one of those similar stocks is CoreWeave. Now, obviously, we've been talking a lot about about NBIS, a lot about Iris Energy as well. But the one that's been rallying, but probably not as much as the other ones, is CoreWeave. If we find some CoreWeave short puts again down in the lower 100 range, or if I can find some accumulation for some shares, not a bad proposition. I mean, even at 126, it's not bad, but if we come a little bit lower here with the market volatility, you will find me playing some short puts again on this stock, and you will find me buying a couple more shares as the base and bear and even bear case scenarios for the stock are very good, let alone the bull case. The bull case is ridiculous, but just the base and bear cases do lead to more share price expansion, in my opinion. Affirm is a phenomenal company. We covered their earnings at the end of the month of August. Phenomenal earnings, and the stock, even at $80, was trading at a relatively cheap multiple in terms of a PEG ratio and price to sales. Happy to say it's now back down here again. You might remember I closed some extremely profitable call options literally on the earnings candle, and I was saying if it comes back down here, I will not hesitate to probably load up more. At the current time, selling put options down here, 70 to 60, decent proposition. But if the price comes down there, I may even be tempted to reload some of my leap call options. In terms of Rocket Lab actually looks pretty good, I'm not gonna lie. They've been accumulating here since the month of July. Although the valuation is kind of nosebleed territory right now, I think the momentum on this one is very clear. In the event that we wanted to play something, if I had to choose between ASTS and Rocket Lab, at this current stage, I probably would choose Rocket Lab, selling some puts down here or accumulating some shares, or maybe just going for the absolute YOLO call options. Not heavy, guys, but you know what I mean. Couple call options here and there, long dated call options on any back tests here of the lower 40s. Not the worst proposition if you're looking for something with a little bit of momentum. Those are just a few stocks I want to cover. Another one that I want to cover that we don't talk about that often is Rocket Mortgage. Rocket Mortgage, if you come back down here, guys, sub 18, phenomenal area, 18 to 17. We are literally just doing a bit of very healthy monthly consolidation on this stock right now. And if you drop any lower, I will be reloading my call options as well. First area for me will be 17, and if for some which reason we make it back to 15 bucks, this is area number 1 for call options for me, leaps. This is going to be area number 2. As for right now, I'm only selling some short puts at the midpoint area down there at about the $17, $18 range. Not looking too bad at all. Now, obviously, there was a bunch of names that dropped today, but we covered a lot of those names in the rest of the videos earlier this week. So you guys probably know my stance on a lot of those companies, especially all of these that are constantly clipping the highs, right? So that being said, if we look at the biggest winners of the day, well, obviously Open Door, but you guys know my thoughts on that. Intel, we have been saying for the past week after the NVIDIA announcement that Intel was a phenomenal buy down here for some lottery leap call options. Hopefully you guys are making some good profits on those. As of right now, though, no further swing trades from me. The stock is currently expanding, getting a little bit top-ish right now in terms of this move. Maybe not, who knows, because they keep getting more and more bullish headlines. I mean, beyond 35, guys, it's going to be tough to position once again, right? At this point, the only leap call options that are on the table are going to be probably the $40 call options. When we were down here, sub 30, we were talking about the 35s were probably the best bet. Like when we were here, 35 leap calls were probably the best bet. But now you got to push it out to 40, and I'm just not sure, right? How high Intel can actually push off this renewed bullishness. Today, they were in talks with TSMC for a partner, for a possible collab, things of that nature. So it seems that everybody is trying to help Intel out. And, just Intel being the company that's arguably too big and too closely tied to the US government to fail at this point in time. So Intel, not the worst play. Duolingo, interesting to see them come back. As I was saying, Duolingo, if you enjoy the stock, it's not for everybody. Low 300s is a decent area to be accumulating some swing shares for some longer duration trades, so keep that in mind. In terms of Rubrik right now is probably one of my favorite cybersecurity bets. In the event we keep consolidating down here, 80 down to roughly 70 bucks. Nice little pocket to be accumulating some swing trade longs. The growth for this company is really strong, and we're going for some monthly consolidation, right? So very healthy price action for the chart. I'm a big fan of playing that one as well. And I think that's pretty much it. If we talk about Elf Beauty, we brought it up yesterday as well. Any further consolidation on Elf Beauty down to the into the 120s again will possibly free up some short put options. 110 down to 100. Very nice location for, possibly some short puts into the market, but also could, if the price comes down there, could be arguably a very nice area to pick up some shares as well, right? I do believe Elf Beauty is on its way to becoming a $200 stock again, possibly into 2026, but especially into 2027 as well. So there could be some very nice opportunities. And even a stock like Booking.com, very solid area of accumulation. I've personally been accumulating a decent amount of this stock at these ranges. So Booking.com, it's not for everybody, but we are just literally looking for the next leg of monthly expansion. Can be pretty good there. And even a stock like Mercado Libre, right, which I don't talk about very often, is looking very ripe, guys, for some monthly expansion. These are just longer term shares, no swing trades, but if you like these styles of companies, right, Booking.com is different. It's just a very high, it's very highly efficient company in terms of the buybacks that it does, but it's the largest travel online operator, has tons of third-party revenue and other revenue sources as well. And they're just very resilient as a company. Mercado Libre is a bit different. It's a massive growth play. So if you like those styles of plays, those are the ones that I'm really focusing on for accumulating some shares. And of course, some of the other tech companies that we talked about, such as AMD, such as Amazon at the current levels too. So, I'm not playing all of the very volatile stocks, but in the event that there are more opportunities that come our way, I'll definitely be keeping you guys up to date. But fairly short, biggest gainers and losers of the day segment. Actually, today wasn't really biggest gainers and losers of the day. It was basically just talking about some plays that we haven't talked about in a while that I was interested in. Okay, so keep that in mind. But with that wraps up today's video. Hopefully you guys enjoyed. If you did, drop a like, would appreciate it for the growth of the channel. Also, consider subscribing to the channel if you're new. We are on our way to 10,000 subscribers, so thanks to each and every one of you for subscribing to the channel and following along for the journey. And last but not least, guys, if you have any questions, as always, feel free to leave them down below in the comment section, and I'll be glad to answer you. That's it for me. Hopefully you guys wrap up the week strong in the Friday session. I won't be doing a video recap tomorrow as I'm still on holidays. I'll be coming back home October 10th, October 11th. So the stream schedules will be returning, or rather the video schedules will be returning to normal. And also I'll be doing more videos per week. As of right now, on to the last 2 weeks of vacation for me. So thank you guys for being part of the journey with me. Thank you guys for watching all the videos so far. And I will see you guys soon on Sunday specifically for the top 5 options videos for next week, of which there'll be many opportunities, especially after a nice red week like this. So hopefully you guys are able to make the most of it. Take care. That's it for me. Peace.